Thank you all for coming to Funded House. Thank you all for having lunch, talking to people, and networking and enjoying yourselves. And we're about to learn about some really interesting topics with some very, very particularly smart people. And I'm personally looking forward to it. If we can all settle down, wind down our conversations, get ready to learn, get ready to sit down and hang out. See, Aaron, what a leader. I know we're just getting started and settled, but I want to say thank you to all the people that have come. But more importantly, thanks, Will. I want to be a little bit louder because I was told to. But ultimately, I don't want to stop the show. I want to get started. With that, I will give you my friend and colleague, Shawn Stigler. Thank you.
Thanks, Mark. All right, everybody, we're going to kick off here. Yeah, Mark, do we need another microphone? It's already trying to take our microphones away. That's a bad sign. Come on up. We're going to kick this off. We're going to talk about the void in information. Seeing some friends out there. The void in information in venture capital and the venture capital market. So come get a seat. We'll give it a second. Oh, yeah. Hello. Yep. All right. All right. The quiet effect is working. Come on in. All right. So first and foremost, thanks so much for the Founded House for hosting us. We're psyched to be here. Psyched to see so many friends and new faces. So today, the talk is really about the data void in venture capital, which sounds kind of technical, but especially as we're going through this change in venture capital, data is everything, information is everything. And so we have two awesome guests, Michael Kelly from Intricacies and Brandon Beck, not to be confused with Braden, which is an inside joke, from JPM. So maybe to kick it off, we'll start with Michael Kelly. Tell us a little bit about yourself and what you're working on and what you're excited about.
Yeah, well, first of all, I'm excited to be here. Thank you all for coming. My name is Michael Kelly. I'm founder of Intricacies. I spent about 12 years actually at JP Morgan. So I've been a professional investor for the last 15 years. I've invested in basically every asset class you can imagine all across the globe, some of which have great information, some of which not so great information. So that's been something that I'm really passionate about and excited about. And my company, Intricacies, is actually trying to solve this problem, so the data void in venture capital. So that's a little bit about myself.
Great, thanks. Yeah, good to be here. My name is Brandon Beck. Have a background in venture capital. Was at a fund located in the Mountain West, an active seed stage fund. Ended up joining one of our portfolio companies, Omni, which was then subsequently acquired by JP Morgan. We're an investment analytics platform for the venture capital industry. So we ingest a lot of the deal docs and data from venture capital transactions and then present that data in a way that's very easily, summarized and understood, and you can manage your portfolio and understand a lot more about what's going on with each company. So, that's kind of a little bit about my background, where I'm at now. And yeah, it's very relevant for what we're discussing today, but excited to be here.
Awesome, thanks. Well, as we kind of touched on, historically, especially in the private markets, whether it's VC, private equity, family office, which I know all of us kind of touch on, it was a really analog process. And so, especially, we've had a few years where, frankly, there was a lot of venture tourists, a lot of investor tourists. It wasn't that hard to get good returns, but that window has closed. And so one of the things we're really looking at now is how to make better decisions, both from an investor standpoint and a company standpoint. So maybe just to kick things off, and Michael, maybe I'll start with you. What is, when you talk about this information void, this data void, what does that mean to you? And especially from, maybe we start from the capital allocator side, how does that cause issues? What's the issue there?
Yeah, so there's a few issues, but for one, we're working in uncertain environments, right? Anytime you're investing capital on behalf of yourself or on behalf of somebody else, right? The more information you have, the better decisions you can make, especially considering the fact that outcomes are so uncertain that, to get yourself to a level of degree of confidence, it takes a lot of work and effort to get there. So if we just look at, for example, data rooms, right? How do I dig into the information of this company I'm looking at and I'm trying to evaluate whether or not I want to allocate capital to it? It's a very archaic process. From the startup side, it takes like 40 hours to build it. From the investor side, it takes a tremendous amount of time to sift through all the stuff you actually don't even care about to get to the stuff you do care about. And then it takes a lot of time to validate the information that you're even looking at to see whether or not it's real. And so the whole process is really, really frustrating. So there's a combination of issues where you have a lot of time and money wasted on that process. And then also the data that doesn't even exist for you to look at, right? So we're constantly looking at founders and we're telling them, hey, we're investing in you. And then we're asking them for all their metrics, which comes through really sloppy and not always really tight. And then we're making a decision actually based on that data, which is really sloppy and not very tight. So and it's also very limiting because even founders only have so much information about their own businesses. And so when you look at evaluating a public company, for example, you can see everything. There's really very little information that you can't get when you're evaluating that. And it's not the same in the private markets, which of course increases the barrier of entry from an investor side and a startup side. And so yeah, that's what it is to me.
Awesome. Brandon, you want to add anything or?
Yeah, no, that was very well said. I mean, I think the core point being like, why does information matter? Information matters to make decisions, and what decisions are being made in this market is, buying and selling these assets, and, controlling shares of companies. And so what leads to the void? I think the void is kind of funny because it's like intentional in some ways. And, in other ways, it's just a matter of technological gaps or time gaps. So we could solve the void. And I say the void is anything from, information sharing between LPs and VCs, VCs and companies, and vice versa. And the types of information that's being shared is anything from performance metrics to economic metrics, legal provisions, et cetera, that helps people make more decisions or better decisions. So if we wanted to point like unlimited man hours at this problem, we could solve it. I think a lot of times though, that just generates more noise. And I think unfettered access to information is not actually what the market wants or needs. Oftentimes people want to control their narrative. They want to be able to curate, they want to be able to sift through the noise and present the data how they want it. So I think the void in a lot of ways benefits some of the players in the market, but it does make it so it's much more time consuming, less efficient across the board. And so I think there's a lot of interesting solutions we can talk about today about groups coming in that are helping people to have access to the information and then choose what they want to share once they have access and once they've aggregated it in a way that's more efficient and less time consuming.
Awesome. And I know there's quite a few investors in the room, and certainly we all work with investors or are investors. It's not a lack of opportunity. It's not a lack of deal flow usually. It's to your point, Michael, kind of sifting and winnowing through that. And so maybe just to cue on what you just said, Brandon, what are some of the tools? And I know you guys, to a certain degree, have some of the tools, and let's feel free to talk about them. But tell us some of the tools, and we'll transition to some other topics as well. But tell us how you're solving this right now.
Well, first, I'd like to double click on the problem, and then I think
absolutely.
And so on the one piece that you just mentioned, deal flow, right? The old joke for every investor is, right, I have plenty of deal flow, I just don't have good deal flow, right? Well, if you look at how many companies actually have these outsized returns, we're talking 1 to 2%. So if you're only getting 1 to 2% good deals, then you're getting relevant deal flow. You have to actually reframe your thought process there. And really the problem is having horrible filtering mechanisms, right? Like I saw some person that has a pretty large following, I won't name them, but talking about how if you use specific words in your pitch, I'm immediately disinterested. And it made me think, like, is that a good filter? Like, how does that actually get you to the 1 to 2% of businesses that are successful? Or is that an arbitrary filter that just helps you get through the amount of deals that you have faster, right? And so I think one of the big issues we have to think about is, what filters are we using, and what's the purpose of each filter? Does this filter help me find the diamond in the rough, or does it help me get through the deals faster, right? And it seems you can probably be successful in both. I think you'd be more successful if you're really intentional on what filters you're using. So that's kind of my thought process on deal flow. And to answer your question, what are some tools that are available that we can look at, right? So from our perspective, mentioned that we're trying to solve this problem. And we believe that the information bottleneck actually begins, starts, and ends with the founders themselves, right? At no fault to them, right?
Yeah, tell us more about that. Yeah.
Okay, so the average founder uses between 13 and 66 software applications to manage and run their business. That's 13 to 66 different information silos, right? So when you ask them a question, right, how are things going? Give me an update on your company. It's not as simple for them to just say, oh, okay, let me write this email, or, oh, okay, let me go look at one thing and then I can write the email. They have to sift through all these information silos, build the narrative, understand exactly what's going on because it's constantly changing, right? And it's a really difficult process, which increases the amount of time that you're sitting there waiting. And so we're actually starting there and solving the information silo issue for founders, which allows us to capture the information on their behalf. And then, at that point, we allow for private and secure information sharing with potential investors and people on the cap table, so real-time information sharing, so you're not even having to ask the founder for an update. So we're working on some interesting things like that, and then allowing for data sharing, controlled data sharing, so that partners can solve problems like filtering and stuff. They can be more specific on that. But
Awesome. Brandon, any takes from you?
Yeah, that's great. I mean, our as a clarification, our product as it stands now is really related to the venture capital funds themselves. Those are mostly our customers. And so a lot of what we've built, and we're doing more down the line to sort of help facilitate the whole market, but as of now, we ingest all these deal documents, and we pull all these key terms out, and we allow the venture capitalists to see what they own, what the liquidation preference is, what the board seat composition is, who their co-investors are. And having all of their deal docs in one central repository with all the key terms pulled out from the source documents saves everyone a lot of legal bills and time to get to the source of truth. And what that does is it actually unlocks a lot of really powerful things. We're able to aggregate all of those, we've ingested hundreds of thousands of deals at this point. We're able to aggregate all of that and benchmark your, portfolio company to those different terms. So you're able to see, okay, like in the most recent deals that were done on this platform, where does this seed stage deal in this industry relate in terms of its terms? And so we're able to help make decisions of like, what is market? Who knows what market is? Well, we know what market is now because we have it from the source documents. So there's a lot of questions around, is this the right, structure for this deal? Where are we at in the cycle? And so I think that's really powerful. Another really powerful way that I think we do it, just one example is cross-pollination. So, we ingest the deal documents from one investor. Let's say there's 13 investors in a company. If you are a co-investor in a company and someone has uploaded the documents already, then you have access to that information. So rather than you having to chase down all these documents, which I actually think for the company getting hounded by investors for all these documents and all these updates, like having one person who updates it and sharing it with everyone else's information rights on the platform, that saves many, many hours and makes it much more clear on about what's going on in the company. So I think there's like, little technological things like that that can dramatically, reduce time to decision that help.
Amazing. Might stick with you for a second, Brandon. I know you guys have both worn different hats, but I was talking to Jamal earlier before we came up, and some of the earlier stage companies are light on data right now. They're building, it's a lot more about the narrative. And so just kind of putting on your investor hat and your what data, I guess either of you, but if you are light on information, it's not so much a void, it's just not built yet. What advice would you give someone to put the best data forward or to build a platform that shows, you're kind of grown up and ready for the big time? And any suggestions there?
Yeah, I mean, I think it's interesting because when I was in the investor role, I think my default was always sort of like oversharing in plenty of ways. At the early stage is better. Like, we want to help you. Everybody is like building the plane as they're flying it at the early stage. And I think like pretending that you're not actually helps nobody. And so the companies that were the best at, like we had some companies that they would just put together like a Notion table where I could see every investor update from the past months. I could see exactly how they were trending, and it was very clear what they were asking for in terms of, we want introductions to future round, VCs, we want introductions to customers. Like, I think in terms of like the information sharing at the earliest stage, I think there's a lot less information, so it's better to share a lot of it. I think at the later stages is when like the curation and there's so much noise. And so a lot of it's massaging that narrative and sort of curating it in a way that's different, kind of than at the early stage, I'd say.
No, super helpful.
Yeah, I would agree with that. I think at the early stage, though, you're really building out all of these systems and applications that you're using, right? So even though you don't have a lot of data, you're actually still falling into the same trap of the silos. And so, it's hard to build a narrative because you're having to pull information from so many different places. But at the end of the day, that's what we have to do. And I think the key is you have to be able to share what your vision, what your story, who you're focused on now, how it's going to grow and expand in the future, and the data points that I do have, right? You can see where we're online in that journey, and you can see kind of how we've started to build towards this narrative, right? And it's going to be different for every type of company. If you're a CPG company or a B2B SaaS company, right? Those metrics are going to look totally different. So the key is just understanding, what story you're telling and making sure that there's an alignment there. Because if there's not an alignment there because you're not sharing everything, right? Then there's going to be a feeling in the investor in their gut, in their stomach, and they say, I don't know what it is, but it just doesn't seem right, so I'm going to pass, right? And you don't want that to happen. So you want to make sure that you are oversharing, you're threading the needle with your story, and you go from there.
That's awesome. Thank you. So just staying on the investor side for a second, the market to add LPs, the market to grow your funds has gotten a little tougher the last 6 months. And so as we have a lot of first-time fund managers or other folks looking to put capital to play, tell us more about how some of the solutions we're talking about, how having good information, dissectable information, like how can you use that as maybe a first-time, well, maybe not first time, but a second-time fund manager or someone trying to prove out a thesis? How can you use that to attract good LPs and have good conversations there?
That's a great question. So that actually, we believe that if we can solve the problem we're going after, that becomes a problem that we can solve that's not solvable right now. Yeah. And here's why. During my time at JP Morgan, I spent a lot of time working and managing the money of qualified investors, right? And so I know a lot of them, and a lot of them don't engage in venture at all, even though they have plenty of assets to do so, and because they view it as a black hole, right? They are smart enough to evaluate things themselves, and there's not enough information for them to evaluate it, so they're unwilling to participate because, quite frankly, they just don't know, to them, they don't know what they're putting their money into. And then also, there's been this big push to expand what qualified investor even means, right? And the SEC has flat out said, we are unwilling to loosen what qualified investor means until there's more information available so that more people can engage. So it's having a direct effect, actually, on venture funds raising money from LPs because, if you're somebody who, the existing LPs have relationships with existing funds, right? So it's going to be really difficult to break in with them. So the next stage is you have to expand the LP pool.
LPs, yeah. Any thoughts, Brandon?
Yeah, I think a lot of these solutions just help reduce the confusion. There's some more standardization that comes from implementing a lot of these, and there's a stamp of sort of, it makes you look more mature if you're using a lot of these solutions and you're showing information in a clear way. I remember reviewing decks that are LP decks to raise money, the number of asterisks at the bottom of the deck of just what it's benchmarked against, what vintage, what companies are included, which ones aren't. It's kind of crazy. And I think with us, we're really hoping that, we have some very powerful features around LP reporting where you can show very clearly how you stack up against the market with very standard metrics. And so that's one way that you can say, hey, I'm not trying to pull a wool over your eyes. I'm not trying to sneak more money from you. Yep. This is how we compare to the market, and our track record should speak for itself. Yep. We're an institutional grade fund because of these tools we're using, et cetera.
Yeah, awesome. Well, I know a lot of us right before we were all just meeting, and of course we knew a lot of the same folks, and Sherry and Ellen and other friends are here in the audience. And we're kind of talking about the digital solution of things, but as we're in a great community, you spend time in the mountains, I spend time in Boulder, you've been here a long time. These are great entrepreneur venture communities. So to either of you, what role does the community play? What role does the opportunities like this play in getting good information out there and getting better outcomes, both for investors and for startups looking to raise capital? I mean, if we're sitting in the audience, whether an investor or a founder, how can you use the power of networking community to get that information out there?
Yeah, I'll start with the dirty secret everyone knows, right? When you're doing a startup, it's messy, it's hard, right? Not everything is exactly as it should be oftentimes, right? Because you're doing too many things all at the same time. But I think as a community, we can do a better job, especially from the successful entrepreneurs who have done it, talking about that, right? Because as a founder who's looking for funding, you want to put your best foot forward. You're afraid to show, what's dirty underneath your hood, right? Because you're afraid that, hey, somebody might look at that and say, I'm not investable, right? So I think as a community, we can come together and say, hey, look, no, this is normal. This is expected. This is okay, right? And the key is to understand, hey, it's this way because, I'm really good at X and I'm not great at Y, and I need help. I need to bring somebody on my team that's really good at Y. And just the mere fact that you know that is actually really appealing to investors. And so I think the community can do a better job of just saying, hey, this is the stuff that we don't talk about a lot, and it's okay, right?
Yeah, I totally agree with that. I also think, community and networks as it pertains to the information gaps, I think like those who do a really good job of community building and networking, they probably enjoy the information void because they don't have as big of an information void. Yeah, totally. And so I think there's part of that. I also think from the digital side, like not to hype JP Morgan, but we are pouring tons of money into Capital Connect, which is a solution to digitally connect all these disparate groups to speed up what's happening in the private capital markets. And so I think that there's a lot of things happening on the sort of offline going online on the community building side. I started my career in a geographically focused fund, and the thesis was very powerful because I think Salt Lake City and Denver and all these places have very strong communities. But also it's starting to flatten quite a bit. And I think in 2024, the community is way more online than it has ever been, and I think you can build a startup wherever you want and still connect to the people you want to connect to. I believe that, and I think there's a lot of these tools that are sort of speeding that up. And I think everything we're talking about relates to it, right? Like, how do we connect the community? How do we make the information sharing easier across different states, different countries, et cetera?
No, because I think at the end of the day, whether you're an investor or a founder, you want the best outcome. You want the most opportunity. We're trying to level up everyone as much as possible, and so the more we can reduce friction to that, and it has been it's suboptimal historically for sure. So speaking of exits, I think one of the misunderstandings is that a lot of venture-backed companies go public or have a certain type of exit, when in the reality is they tend to sell. They tend to sell to a strategic, meaning someone in that industry where they fill a niche, or to private equity, or a transaction like that. And so maybe talk about how, again, from whatever side of that ledger you want to take it on from, but how optimizing information, filling this void, having better transparency, how that's going to lead to better and more outcomes, again, for that group of people.
Yeah, so there was a chat earlier today, actually, that talked about how the bid and ask between investors and founders were really wide last year, right? So a lot of founders really thought their companies should still be valued really high, and a lot of investors are like, no, right? That's not going to happen. And so I do think that filling that information void really will impact tremendously the founders in one way that better aligns their expectations, so that bid and ask can actually be closer together, so more transactions can occur. And that's a transaction whether you're receiving a check from an investor or from an exit, right? Because at the end of the day, you're just talking about valuation. So I think that's really helpful. It allows for everyone to be at least closer onto the same page. So I think that's one way. Two, whenever you're actually better whenever you're better at tracking kind of historical trends and current real-time trends, the problem right now is information is so lagged, right? So if you go on and you're looking at, oh, well, these are the valuations right now, are they? Right? Because these are based off transactions that were actually happening, maybe 3-6 months ago, right? Maybe even 12 months ago, depending on which charts you're looking at.
Which slow lawyers got the deal done?
Yeah, exactly. Right. And so I think that causes a challenge as well. And so filling that void, I think, just allows for people to be more confident in the information that they're looking at. So it's a little bit easier to pull the trigger on some of these transactions.
And it has seemed like, just the end of last year, that bid-ask spread was so big, and it really slowed things down. And then I feel like it's correcting, and now those of us in the industry are seeing a lot more transactions, but it would have been so nice to not have to go through that 6-month winter. Yeah. Brandon, any thoughts there?
Yeah, there's less cash in the bank now. So your willingness to sell is higher.
Yeah.
I agree with what's said. I think I don't think I have anything much more insightful to add than what Michael said. I think a lot of this does relate to that. Like, evaluation in the private markets is outdated kind of the day it's closed.
Yeah.
And there's much more efficiency in the public markets where it's more regulated, it's more standardized. Yeah. There's a daily bid on the price, and so I think there's just a lot of efficiencies that, I think there's initiatives in the private markets that are sort of pushing us towards, quicker secondaries, or platforms that can sort of make stuff happen on the liquidity side that's much more interesting.
Yep.
But until we get there, it is, there's definitely a lag.
Yeah.
And I'll just add one more thing. So, we're going to be building a lot of indexes and benchmarks, but from a different perspective than what y'all do, which is why there's lots of potential crossover with what we're doing. But, we're going to be able to show real-time numbers on like CAC, and real-time numbers on gross margins, and real-time numbers on each individual company. Oh. And so we can aggregate and anonymize that.
I was going to say anonymized,
anonymize it and build indexes. So when an investor or a founder is looking at a deal in front of them and it says, hey, the average valuation should be 15 million, let's just say, right, on an early stage deal. But hey, the founder's asking for 20 million, but they're crushing all of these internal metrics against their peers. Maybe they deserve 20 million, right? And now, like, okay, that actually makes sense. Yeah. This is somebody I want to back because they're crushing it, and let's rock and roll. And the founder has the ability to actually defend a valuation. And that just goes back to feeling confident in what numbers we're actually talking about and looking at.
Yep. Because it has been such a black hole, and it's also hard to just compare apples to apples because might be an outlier here or there. Speaking of that information, I wonder if either of you might share, and feel free to just look at me sternly or kick me in the shins if you don't want to. But if I had those shoes on earlier too. But if there's information either that, wow, this was a data point that I hadn't thought of, or that really made the difference in a deal, that I got it right, or information where you're like, oh man, I totally blew this stop sign looking at something and I missed it. An example of either of those? I can offer my shins now. I didn't prep you with that one.
I'll say I don't have necessarily a major example that pops into mind. I'm sure there's quite a few of them. But what I will say is one of the things that long term we want to build out is what are the arbitrage metrics, especially the ones that aren't fully obvious, right? What are the non-obvious insights that we're able to start pulling from because we're actually starting to index all these internal metrics within these different companies? I like to joke that, like, all right, well, the company that is in their CRM tool on Tuesdays at 10 a.m., for some reason they have more success, right? Yeah. But then that arbitrage goes away because now everyone's in their CRM on Monday morning, or on Tuesday morning at 10 a.m., right? But looking for these non-obvious insights that allow for an understanding of, hey, this is actually a leading indicator of what could be indication of success going forward. So.
And just so I understand, frankly, how are you going to, with your platform, just to talk about it a little bit, like how are you going to track all that? Can you tell us a little more?
Yeah, so after this, for anyone that's interested, I'll actually be doing a product demo in the back left conference room in the other area. So, I'll be able to talk more about it there because I think the visuals make a lot more sense. But we're pulling in the data automatically from all of their applications that they're using. So the founders don't do anything except continue running their business on the same applications that they already run their businesses on.
When you say applications, like, what are some examples?
I mean, QuickBooks, right? HubSpot, right?
Yeah.
Notion, right? Like the same stuff that everyone's using, right? And then we're centralizing and actually empowering them with the information, so they don't have to go in the apps to see the info. So that's kind of the first step, right? And then providing kind of that secure and private way of sharing that. So hey, you're interested in investing in my company, awesome. I'm going to give you temporary access, right? I get to control who gets to see it because that's the other piece, right? That's why nobody will share their information with PitchBook or Crunchbase. They don't want their information publicized, right?
For sure.
So those are the things that have to be in place for that information to be, willing to share it, basically. So.
Yeah. Awesome. Brandon, do you want to share any war stories or no? Or insights?
No, yeah. I mean, I think the question around sort of like what's a information data point or something that influences the way you think about something. I think one of the most powerful visualizations we have on our platform is like the lick-pref stack, and it's like when people open that up and they can just like see how deep it is on a company. It's like, whoa, that is.
Just in case some folks aren't liquidation preference, like tell us a little more. Like what
basically when you're exiting a company, there's certain people have priority in receiving their money before you do. And so, if you raise a certain valuation, there's a liquidation preference stacked before you even, like even a founder would get it. So you could sell your, I remember hearing horror stories when I was getting into venture of founders that sold their company for $400 million and made basically nothing.
Totally.
And it was like mind-boggling that could happen. But I think when you get ahead of your skis and you start doing all these rounds and you just are like, it's a lot of legalese, right? It's like a lot of these people are just doing the deals and not really noticing what's going on. And you can get to a point where you're pretty deep on what you owe people by the time it exits.
And just to add on to that, why that's so important, for any investors or startup founders that haven't looked at liquidation preferences and really thought about how it impacts you, liquidation preferences are one of the single biggest reasons why the housing crisis turned into a financial crisis in 2008. Right, and destroyed the whole economy almost, right? And so it has a huge impact. So not just on you, but your employees, right? Other investors, and for the people that back you and provide money to you, you should take personal responsibility in ensuring that they get the best outcome they can possibly get because they bet on you and they decided to, this person is worth betting on, and I trust them and believe in them. So, it's on you to make sure that you take care of that trust. So make sure you understand that. It's really important.
And again, this is a rogue question. So, but understanding, the last 6 months, 9 months, 6 months, we've really seen it was such a founder favorable market for the last 2-3 years, and now those of us who have been around a while, we're seeing a reversion back, and we're seeing terms we haven't seen for a while, participating preferred, more aggressive pref stacks, all these different things. And so from an information standpoint, are either of you tracking that side of things, sort of where the market is legally? Just, I have to put on my lawyer hat once in a while, so.
Yeah, that's what our platform does. I think I should have been more prepared knowing those exact percentages, but those are definitely going. More onerous terms are going up.
Yeah.
Down rounds are increasing as well. Like, definitely, it's becoming more investor favorable. I think in a lot of ways, companies were preserving their dry powder for the right moment, and investors are doing the same. And so, the pace of deals slowed down. Yep. I think different stages have different outcomes, right? Like later stages were more affected. I think a lot of seed stage companies were still getting done. AI deals were as hot as ever. So I think it affects different parts of the market different ways. Yeah. But like broad strokes, yes, all of those provisions are kind of increasing.
And from our standpoint, we believe that a partner is better suited to do something like that. Yep. So we just partner and bring them on platform.
Yep. Perfect.
Yeah.
Because I think it is. I mean, again, there's this disconnect because people talk to their friends who had a financing or had an exit 6 months ago, and they expect the same thing, and it's just the world's different. So yeah. Well, we're kind of getting, where's Mark Nathan? We're getting to about the juncture where we were told to take questions. So I know you talked about the demo already, so maybe if anyone has questions, but just a reminder, you're doing the demo across the way.
Back left conference room, back over there, and it'll be from 2 to 3. So
Awesome. Well, with that, any questions anyone would like to raise?
there's a microphone right here if you want to jump up and.
So apologies in advance if this is a bit of a redundant question, because we did ask earlier about like a piece of data that was important, and there are so many signals that you have to consider, but if possible, could you share an example of a time that there was a piece of information that changed your decision, either as an operator or investor?
Yeah, I mean, so for one, and I hope this answer helps change some decisions of some of the investors that are listening, but all of the alpha in venture investing right now is pre-seed to seed, right? All of it, right? I mean, just look at Instacart, right? It's a perfect example. However, the problem is you've had a lot of industry, like private equity industry type guys who saw the power law and said, hey, let's move downstream because the power law looks really attractive, and they brought all the requirements with them. And that dries up the well, because now you have a bunch of startups that can't meet, they need funding to get to those requirements, and then so they get left in the dust, and then you're not going to have any deals left, right? And so, but all the alpha is created before they can even get to you. So, we need to rethink that. And for me, as somebody who has invested in a lot of different asset classes, that was something that I had to really take a look at, right? So I'm very much an alpha seeker. I think in different markets and different environments, alpha exists in different places. And so, and for those of you who don't know what alpha is, that's outsized return from the risk that you're taking, which is the other piece, right? The more risk you take, the more return you should expect and you should get. So I think really what it is just paying attention to information, how it changes, why is it changing in that way, and how does it impact that? And that should be looked at in terms of your own business internally as a startup founder, and it should be looked at from outside trends as well as an investor. But yeah, I mean that's one specific example for me that you just have to change and adjust and learn kind of new ways of doing things.
I can take one on since I just got to ask a bunch of questions for the last 45. I think, is it Zach? Zach?
Yes,
yeah,
it is.
Hey, Zach. So just to be a lawyer, the answer is it depends, I think, a lot of times. And I think, especially for software, SaaS, churn, customer acquisition, time in the app, things like that, CPG, points of sale, SKUs, things like that. So it can really depend. I think these guys specifically told me not to plug for them, but to plug for them. That's why I think having a unified source of being able to harness this data, and having been a founder, working with a lot of founders, not spending 25 hours a week re-sifting through crap to get a report ready for investors. I mean, I think it means all the world, because also putting the investor hat on, some funds have really narrow theses. And so you might not even know the metric or the variable they're really optimizing for. And so being able to have that data is so important, and not having to kill yourself to do it is awesome too. So Brandon, I didn't mean to talk over you, but.
No, I appreciate it.
Yeah.
I mean, I could speak in generalities. One story that comes to mind that maybe is a little bit more about what you're saying. I remember we had a company pitch us that was like a dating app, and it was a video dating app, and they said that their users were on the platform 3 hours a day, and we were like, okay, we'll give you all of our money now, like, yes. And we ended up digging in, and it was they logged on. So if, like, for example, if they logged on from like 1:59 p.m. to 2:01 p.m., that was 2 hours, because they had logged on 2 separate hours of the day. And it was just one of those moments where, like, oh, this conversation's over. Like, their numbers were completely off base, the way they communicated them, the way they presented them. And so I think, like, obviously that's the whole job as a venture capitalist is to, like, kind of figure out what the truth is and, like, make sure you're making the right decision. But there's lots of moments like that where like there's just no standardization, and there's no way to view that side by side with another company. So you have to like have these one-off meetings, and we met with them three times more than we should have because we misunderstood what was going on.
I think that feeds into a great point too of like overstating things or misrepresenting will end you so quickly in the community. I mean, not end you, but like shut that door for capital. Yeah, that was too harsh. Sorry. Yeah.
Thank you so much.
Yeah. Thanks, Ed. Yes, ma'am.
I'm a little vertically challenged. So I'm working with a really good friend of mine who's a consummate entrepreneur. And he launched a company called Jacked Up Fitness like 3 years ago. In 2021, as a response to COVID shutting down his gym, he just said, I'm going to make my own home gym. He's doing $30 million this year. He bootstrapped the whole thing with one prototype that he had manufactured in China, took out a $1,000 Facebook ad, and sold a container load within the first 2 months. And now he's just like a rocket ship. I'm helping him with his branding, with his website, and all the kind of great stuff. So now he's at the point where he wants to go and raise some money and to really kick this into high gear. So, you know, the growth has been phenomenal. I think it was last year he did like 8.5 million. He's going to be on track for 20.5 million this year. I mean, kind of crazy. So the question is valuation, and you know, since he's bootstrapped at this point, should he even consider going after VC money or investor money? And you know, he's thinking about it, and you know, I mean, they're like the new Peloton potentially.
Yeah.
So I'm just
Except
curious.
with a better outcome. Yeah.
Well, I mean, just to get that kind of growth, and you know, is that a unicorn? Does that happen often? Yeah. And what would you say would be the advice? I'm just texting it with him now.
Yeah. Well, no, that's a great question. We really didn't touch on valuation as part of this conversation. It's a great point. Thanks for the question. I certainly have thoughts, but I can defer to you all to start.
I mean, I'll answer a couple of the questions. I'll leave valuation out of it because I'm not a CPG expert by any means. But as far as, you know, does this type of growth happen often? It does, believe it or not, right? It's really about the next leg, okay? And should he raise venture capital? Well, you just need to ask him one question, right? Venture capital is rocket fuel. It's either going to blast him to the moon or it's going to blow him up on the launch pad. That's the way it's designed, right? And is he okay with being blown up on the launch pad? Yep. Or does he want to just keep making money and be happy with where he's at, right? You have to think about what change is occurred once you take venture capital money. It's not going to be the same experience that he's had to this point. And so I would first ask him, are you aware of how your life is going to change, right? The expectations are going to change. And are you okay with the possible outcomes that can come from this? And if the answer is yes, because you know the moon is worth the risk, right? Then by all means go for it. But that's the first thing that he's got to answer before he can even start understanding whether or not he should take the money.
Yeah, I mean, I think to that point, it's like I think VC funding announcements in 2024 are similar to like buying. It's like you're just buying a Ferrari. Like you want your friends to see that you like how much you're worth. That's like for a lot of people that have bootstrapped. I think people I know that have raised money, they almost want like the institutional investor stamp of approval of like they're a legit business. And I think in a lot of ways, it's just lifestyle. Like, what do you want out of, you know, do you want to continue to have sort of this control in this direction, or do you want more professional help? Because I think at times, like, institutional investors actually can bring money, but they also can bring different perspectives. They can bring validation that gets you to the next step. And so it just depends on what type of approach you want. In terms of valuation, I think like our conversation, or you know, here is what's the information that's going to inform that valuation. It's constantly changing. It depends on the quality of the partners you're talking to, et cetera. And so I think I off the top of my head, I couldn't tell you valuation. If I could, I would probably be worth a lot more than I currently am.
Yeah, just like things to think about. Is it, you know, is it kind of looking at the growth trajectory and sales that have exploded, and looking what kind of, you know, is it a function of that? You know, what would be a good way to kind of justify a valuation when you go and speak to investors? That was
that's a good question. I think a lot of it, there's so many factors, and one, you know, a big one is like, who's the jockey? Like, who's the team that's taking this to the next level, and what's the ceiling on it, and all those questions. So I think it's a great question. I think there's a lot that goes into it.
All right. Well, thank you.
Yeah. Okay. You go. I won't even answer. No, I was just going to say too, I mean, depending on whether or not to raise venture capital, I think both our panelists touched on, or fireside chatists, son of a, touched on it. But I also think there are other types of capital now. And especially depending, the advice we give a lot of times is if there's direct competitors to the market, it's a race to customer acquisition. It's worth that rocket fuel risk. If you have some serious moats, you have some protection, you're willing to grow slower, maybe there's some other tools you can use that are less dilutive, less, sort of 1 or 0. So
I think he's interested in rocket fuel.
all right, let's do it.
That's more fun.
Yeah,
It is.
totally.
And he's not 60 for nothing. I mean, he's an older gentleman. He's been around the block. He knows what he's doing.
That's awesome.
So he's hitting lightning in a bottle, and now he's just thinking, where does he take this thing?
Yeah, and to answer the last question you said, growth, right?
Yeah.
That's what VCs want.
Yeah.
So you
And
lead
that's
with
what
the
he's got.
growth, right?
Yeah.
And the growth story you just told sounds really appealing. So I think that's a good story. That's what you lead with.
Okay, cool. Thank
And
you.
even last thing I'd say in the marketplace, that type of business has some limitations on its total trajectory and sort of hockey stick. And the last couple of years, that was less in favor. And, like folks like Skew and the CPG world and things in that sort of hardware, software space have come a lot more in favor lately because the likelihood of it crashing on the launch pad are a little bit less because there's still an element, a recurability versus like the next Facebook. It's either a 1 or a 0 and you're going to burn a lot of cash. So it's actually kind of an interesting time. Not that I'm giving investment advice.
Huh, great. Thank you.
Yeah. Any more questions? Oh, from the back row.
Hi, thank you very much for the talk. I loved it. And going back to the technical and the issues we were talking that you see in startups, how much for a VC does the technical quality assurance is valued before they invest? Does a founder has to have the best product to show it to the VC, or can it be a poor MVP in order to go and look for money? It's a technical question, but yeah.
It's a great question.
So you always want to put your best foot forward. So I like to say if it's put together with duct tape, try to make it not look like it was put together with duct tape, right? Just because you want people to feel excited about what you're doing, right? At the end of the day, as much metrics that go into justifying decisions are an emotional experience. And so, I would say you want it to actually look really, really nice if you can. But no, right? They understand, especially if you're telling them, hey, with your money, I'm going to be able to professionalize this product. Here's the plan on what I'm going to do with it, right? How we're going to do it. You need to be able to answer that question really, really well. But yeah, as long as you've got something to show them, they can see the vision, right? That investor invests at that specific stage, right? It takes a specific investor to come to whenever it's in that position. But that's what I would say.
Yeah, great question. I think it depends a lot on industry and stage. I think if you're, and also like the founding team. Like if the founding team has built something incredible before, I think there's going to be a lot of like a rush to probably put money into that company pre them building something. I think if you have no track record, you have to build more first. I think if it's a extremely technically difficult product to build, you probably can't build something that's going to do it justice without money. So I think there's a lot of like questions that dictate that, but in a lot of ways, like if it's something you can easily prove by spinning up a website, it's not super technically difficult. Then the more you can prove that way, then you should. But yeah.
And I think we don't know your company, but I do think the market. We joked about AI. We just closed a $3 million seed round in an AI company with 2 historical founders who had success in 48 hours. They went to a couple of VCs with an idea. This is what we're going to do. Checks got written, safes, 48 hours. So like that's great founders, great background, great market, hot market. So it really does depend. Yeah.
Thank you very much.
Thank you for the question.
Yeah, thanks for the question. And happy to chat more after, too, if it can be more specific.
I have a question more about alternative markets to Silicon Valley, Austin, and that. I live in Houston. There's a lot of subject matter expertise there, but capital in search of an identity, and so there's just really no funding for deeply technical pursuits. And so you have these founders with these super cutting edge ideas that can't get funded on AI type projects, for example. So what do you recommend, I guess, in terms of, I don't know, like it's even hard to get a referral if you're not in these networks. But I think opportunities are being missed. There's a ton of industry there. There's a ton of subject matter expertise, et cetera.
100%. I'll just cue it up, but I think this is such an issue in the industry, not just in markets like Houston, but even Colorado. There's a big initiative for rural entrepreneurship because we have so many great ideas coming from there and they don't know how to plug in. So it's a problem, frankly, both these folks are working on solving. I'll turn it over and I'll chime in as well.
So I think in terms of like, I think it's not an easy problem to solve. And I think certain states, frankly, have done a better job than others, and certain communities have put more money into grants and other things. I think in terms of like commercialization from universities even, if there's something that's super technical, that's like years away from being commercialized, I think getting tapped into the grant / like university communities where you can like have some support to nurture the idea along until it's ready for venture capital. It kind of back to the comment earlier around like, it depends on who's doing it. And if it's someone who isn't traditionally in that network, it's gonna be really hard without getting tapped into something that's more of a stamp of approval, like a university or a government grant of some kind, I think.
And I think, sometimes we have to just deal with the truth, right? So I'm in Dallas, so I hear you, right? I experience it in Dallas as well. The truth of the matter is, in Dallas and Houston, there's tremendous wealth that was created in commercial real estate and oil and gas, right? And so all of that wealth was created in deals that have a yield attached to it, right? It's a totally different structure, totally different asset class, totally different understanding. So the people who actually control that wealth don't even understand the technical deals of the deal, much less the business, right? And even if they get the business and like it, they don't understand the actual technical components of the deal, right? And it doesn't fit in their portfolio. I think this is a pipeline issue. This will work itself out over the next 10, 15, 20 years as that wealth passes down to the next generation who is really interested and curious about new technologies. I think Texas will actually become the place for venture capital going forward at that point. Part of the reason why JP Morgan is moving a lot into Texas actually and investing a lot of money here because it is the future of the country. However, I think understanding that that's a fact right now, and then it's on us as founders, right? We have to say, all right, well, we need to, pull our pants up and put our jacket on and go find the money, right? And we need to network. But the key is, and the reason why I say that we just have to be honest is, if we just keep networking in all the wrong places, we'll never get the money. And so I think it's going to have to be, hey, you might have to come to Austin. You might have to go to Silicon Valley. You might have to go to New York. You might have to go to Boston, right? And you might have to be building relationships there because at the end of the day, we've got to get something done and we can't keep twiddling our thumbs, right? But that would be the best advice I could give.
Can I ask one follow-on question? So how do you protect, in my case, I filed a patent around something. And then I started pitching in Silicon Valley. It was very deeply technical. It would cost like a crazy amount of capital to basically, get off the ground. And some founder that was funded by YC and Stripe essentially took the patent, went on a podcast. They ran into some headwinds, went on a podcast and discussed verbatim that this was his new strategy. And he actually even used my 3 extremely specific, could not possibly be, a coincidence examples in the podcast, in a public podcast. So how do you protect yourself if you do have, essentially the great news is last week, this is 4 years ago that I filed it, I got the patent issued. So I actually own the IP, but the fact is, how do you protect yourself if you're not in these networks, if you weren't a former Google DeepMind person and you're trying to do something totally cutting edge, but you cannot protect your own?
Yeah. Yeah, it's a really, I'll chime in on that one. First of all, I'm sorry you dealt with that. That's terrible. And in general, the community tends to be pretty self-policing. And people who do that get run out of the space pretty quickly. So I'm, again, sorry that you had that experience. And I think maybe we can chat offline. I think there is, similar to fundraising, there is a lot of strategy and thoughtfulness that can help support and protect you about those things. And then when they're, I mean, bad actors are hard. We see it in all verticals. I mean, frankly, some of the really big tech companies will just buy or otherwise usurp, opportunities. And so they're starting to pay the piper. I mean, if you watch the Wall Street Journal, some multi-billion-dollar fines were just levied on some companies. So hopefully that'll change the culture. But yeah, maybe let's chat offline. And I think to close the loop on the fundraising thing, I mean, I think Houston is going to be a great market. I moved to Boulder, Colorado 23 years ago. It was not a startup market. Austin was not a startup market. And all those communities honored their sort of tradition and heritage and sort of what they bring to the table. Houston will get there. And in the meantime, plug in with good people who want to support you. And if the money's not in Houston, we'll find another place. Dr. Nathan, I'm getting the just shut it off. You're done to us. All right. Well, I think with that, we're wrapping up. Yeah. All right, everybody. Well, thanks so much.
Thank you.
Thanks, Michael, Brandon. Reminder, Entrecore's demoing across the hall, so check it out. Thanks so much, everybody.